Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, chugging along into the end of the week. The big update, of course, is no update in terms of overnight action from India, Pakistan. I mean, I think we closed into a market. We closed markets yesterday. That was a big talking point. Whether we're going to wake up like we did yesterday to some sort of escalation. There is no escalation from Pakistan. That firing continues across the LOC. So I think for now, I think it's something which is holding on, and we'll need to watch that closely. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me my colleague Surabhi and Nigel. Guys, hi, morning.
Hi, morning. Yeah, a bit of a tense night, but thankfully, as of now, I mean, not too much has happened. Though, of course, there's that firing that's going on. Wait and watch mode. A lot of other cues as well. I mean, we've got the Fed. We have plenty of other cues to look at as well.
Well, that's right. An eye on the border. But as you said, we have the Fed to look at. And Trump is hinting at one of the first deals to be announced later today. So let's see how that goes. So we've got our plate full. Let's get straight to the action.
Absolutely. Let's take it from the top then. As I said, the big story, of course, is that there is no escalation from the Pakistani side overnight. When I say escalation, I mean, some attempt at a counter-strike, etc. Cross-border shelling, of course, continues, and very, very unfortunate, the loss of lives in areas like Poonch and some other areas as well. But, in terms of big escalation, there is none, at least as of now. Now, we had the Fed decision last night, and I think that took a complete backseat because it was basically nothing new at all. I mean, I think we'll spend 30 seconds on it. The mantra was wait, see, and watch. Powell essentially said we don't think we need to be in a hurry. We think we can be patient. So he's kind of ruled out any preemptive cuts in terms of responding to a slowing economy, etc. He said, well, sentiment is bad, but hard data is still not bad. So we'll need to see that sort of start to come through. What did markets do to Fed pricing for the June meeting of FOMC? There's a slight reduction in what the Fed is pricing. I mean, so now it's 5 basis point cut compared to 8 basis points. I'm just putting that out just to sort of tell you how little the change really was. And of course, I mean, there were no rate changes at all. Now, equities held on steady last night. S&P was up 0.4. NASDAQ was up about 0.25%. Dollar index about 99.9. Oil continues to come off. Oil prices are now $60.90, almost $61. So we had a bit of a bump last 2 days in oil. And we are down back about 2% last night. Now, Trump has essentially teased out a major trade deal with what he called a big, highly respected country. That is later today, I mean, U.S. morning. The New York Times and other publications are saying, well, the deal could be with the U.K., so U.S.-UK. And I think we'll need to see if this is the one. More than, what this deal would mean for global markets. I mean, markets, of course, if we get details, if this is a framework deal, this is the actual deal, most likely it's a kind of a framework deal and things that they've agreed to do. And then the negotiations will go on. But it'll be seen for what is the U.S. willing to do and give in as a sort of, to use it as a sort of a template for what may come next with countries around the world. Last night, President Trump said he's unwilling to lower tariffs to get China to the table. Some in the market have been saying that U.S. will cut rates from 145% on China to something like 50-60% to get China to the table, and then they'll start talking. I mean, Trump actually pushed back to that idea. U.S. envoy has reportedly been sent to China, so watch for headlines there. And of course, over the weekend, U.S. and China are meeting in Switzerland to take these trade talks forward. I mean, this is, of course, just FYI, we reported this yesterday. EU, by the way, today is going to make public a list of about $100 billion worth of U.S. products that it could hit with tariffs if negotiations don't go well. So keep an eye out on that as well. Now, just to circle back and tie in the levels, yesterday was a good session. Broader markets did very well, although the Nifty and the Nifty Bank did not go anywhere. But this looked like a market which wants to go higher. Now, we need to, for that to happen, we need to clear a few levels. 24,589 is the first level the Nifty needs to clear. On the downside, the low of 24,198 is an important level to watch out for. Nifty Bank, the immediate resistance is the 40 hourly exponential average, which is 54,747. The resistance then after that comes in at the high, 55,692. On the way down is the 20-day moving average, which is 53,695, which is going to be the first support. And then there is the 40-day exponential as well. GIFT Nifty gives you a quick sense of how we're likely to start. It's neither here nor there once again, at least on the Nifty's 30 points down. Surabhi.
Yeah, absolutely. I mean, markets have been fairly range-bound across Asia this morning as well. Not too much to react from that Fed meeting. So it's mild gains in some of the regional markets like Hong Kong, like China. So small gains coming in over there. 0.1%, 0.2%. Those are the kind of indications we're picking up. The Hang Seng is doing relatively better. It's up about 0.6% right now. It's a wait-and-watch game to see if those Swiss talks, Switzerland talks between between US and China, whether they yield any result or not. So it's a bit of a waiting game that's going on. US futures, by the way, had turned positive. Last I checked, they were up. Some of them were up as much as 0.5%. So the US market, and even now, yes, they are up and about. They're chugging along. Gold prices are a little higher once again this morning, 0.7% higher. So that's the overall backdrop. Quickly coming to, of course, the situation here at home, and this is the latest. This is what we know as of now. Of course, there is Operation Abhyas that continues to play out throughout the country, which is the mock safety drills, etc. And the the government has been reporting there are a lot of civilian volunteers who want to participate as the first line of defense workers here. So that's good news. The heavy shelling that's been taking place along the international border and the LOC, that, according to our sources, has claimed 15 civilian lives already. And that's the update as of last evening. So we'll wait for more updates today. 43 people injured. And of course, yesterday we had that statement coming in from Mr. Doval. He says there is no intent, on India's part, there is no intent to escalate tensions, but we're ready to retaliate resolutely if Pakistan decides to escalate. So India is on high alert on land, on the seas, and of course in the air as well. All of this, by the way, did not deter FPIs. They were still coming into the market, which is good. I mean, they are not too unfazed by what's going on, at least for the time being. 2,600 crores of FPI buying came in, about 2,370 odd crores of domestic institutional buying. That was also supporting the market, which is why we had a fairly good session yesterday. In fact, mid-caps did so well. The mid-cap index ended about 1.5% higher, close to the day's high. So there was buying at lower levels that was seen, and we'll watch out to see if more of this continues. Today, my sense is that it will be earnings that start driving the action again till we get more geopolitical updates. So we have Coal India's numbers to go over. First glance, they look better than expected. Dabur is as weak as what we always imagined. The volume growth is down about 3%. Margins have declined about 150 basis points. UB is a good set of numbers. Watch out for this. The margin expansion is about 0.5% more than what our poll was indicating. Then we have a lot of these AC and cooler companies, the summer guys. Voltas, Blue Star, Symphony. We'll watch out for all of their numbers. Most look okay. Blue Star's AC business, as they call it, the unitary cooling products business, that growth is a little lower than estimated. Symphony is lower. So let's see how these numbers do. But Nigel, I guess my sense is today we'll get back to talking individual stocks and earnings.
Well, that's right. Actually, it was a resilient performance coming in from the Nifty yesterday. But I think in the near term, maybe there could be a case for some consolidation to continue. Remember, today is the weekly expiry as well. So you have volatility that will pick up, particularly in the second half of trade. Now, the biggest positive for me yesterday was that we started with only around 180, 190 stocks that were advancing in trade. But by the time we wound up, we had 1,600 stocks. So just look at that. The way the green line moved, that told you that the markets, in fact, are willing to look ahead. And that's why you had some deployment of money in yesterday's trading session. The VIX, that's the one that needs to cool off. In the last 1 week or so, the Nifty has been more or less flattish. But the India VIX actually has popped up. And that's telling you that, the way the VIX has moved up, just in the last week or so, it's up by close to around 8% or thereabouts. In the last 1 month, it's still lower. But in the last week, it's actually moved up. That's telling you that fear index or, that uncertainty still prevails in the market. There is still fear out there. You'll want to see the VIX actually cool off a little bit from around this 19-odd mark. That's going to be the key trigger for me to watch cooling off of the VIX, which it did yesterday and today, but towards the end, it did pull back. Well, what did the FIs do in yesterday's trading session? They covered close to around 4,000 shots in trade yesterday. Now the long short positions are at even Stevens at around 50% apiece. And for the first time since October 4th, the FIs actually are mildly net long by a few hundred contracts, but they've moved from aggressive net short positions to net long. You like some shorts in the system actually, but for the time being, the FI flows in the cash market is doing the job for the bulls. What did they do in the on stock futures? Well, they covered shorts. 20,000 contracts were covered on the short side. You had some long addition as well. So net longs added on stock futures in yesterday's trading session. On index options, you had higher number of puts that were written than calls, and that's telling you that the bulls want to defend lower levels. Which brings us to what are the clients doing as well? Well, the clients in yesterday's trading session, after adding some shorts in the last few trading sessions, well, we did see that the client net short positions did come down by close to around 10,000 contracts. So there was some short covering that we saw from the client end itself. And for the markets on the whole, there was some short covering that we saw. The Nifty Bank recovered considerably from the low point of the day. And the open interest on both those two, futures contracts were actually lower, both the Nifty as well as the Nifty Bank. Moving to the options data, two strikes were active. The 24,400 call fairly active in trade. The 24,300 put fairly active. Remember, these strikes expire today. Which brings us to the levels. Just looking at the options data, looking at the positioning of the market participants. Well, the levels that I'm looking at, yesterday's low. Yesterday's low should get defended, both on the Nifty Bank as well as on the Nifty. And for the Nifty, actually, the options data as well suggests this 24,200 odd mark is the crucial level you're looking at. On the upside, though, the 24,550 mark, that it appears to be the level that we'll see some resistance coming in there. The bulls will like to conquer this mark to get us to a fresh leg up. The stock that I'm tracking is going to be Symphony because those numbers actually look very, very good. Keep in mind, in the last 1 month or so, the stock has seen a bit of a rally. Though from the highs, it's still more than 30% off the highs. And those numbers look very, very good. 20% beat on the revenue. It came down to the EBITDA number as well, the higher top line beat. So that's a stock I'll track because over the last few days, stocks that have done well actually, they have seen good amount of buying. So I'll keep an eye out on Symphony for trade today.
Absolutely. Those numbers looked quite phenomenal. Absolutely, Nigel, on the radar. So let's get going with our first guest on the show. We have Jahangir Aziz, Head of Emerging Market Economics Research at JP Morgan, joining in. Jahangir, good morning and thank you so much for being with us. So much going on in the world and so much in our neighborhood as well. So just put it all together for us. I mean, it's things are shifting so quickly. You have this geopolitical risk here in India. I don't know whether at some point in time that needs to be baked into, overall financial estimates. And then you have the, the trade negotiations with US and China progressing along. Tell us if you think that there could be a breakthrough here. And amidst all of this, I mean, how do you see India placed?
Look, I mean, clearly, the global financial cues are going to be the big driver. And the announcement that US and China is willing to at least initiate talks has been a positive news. We need to wait and see what exactly comes out of that meeting at the end of this week. For my end, I think that establishing who is going to negotiate on behalf of the US and behalf of China is probably the key sort of signal that I'm expecting from that meeting. Once you have established who the key negotiators are, then at least you know that the two sides are serious about talking and putting together a framework. I don't expect any discussion on what the framework or the parameters of the discussion would be. My sense is that, if we get simply the names of the key negotiators for each side, I think that would be a big positive move coming out of this weekend's US-China talks.
Okay, fair enough. Jahangir, good morning. Good to have you with us. And there's always so much to talk about, right, nowadays, especially with regards to trade. This UK deal, US-UK deal, which many publications like the New York Times are saying we'll get to see today, will markets parse through it to sort of see the amount of give and take, which is possible, the amount of leeway there is, and kind of sort of use it as a template? What's your sense?
So I think clearly it's important for for India, right, and for the US in the context of bilateral trade. What is happening on what kind of parameters or what kind of template, as you pointed out, we get of the US-India trade deal. But I don't think that globally has that much of importance. What really is important, or what or global clients are looking at, the global financial markets are looking at, is what happens to the US-Japan and the US-Korea, but particularly the US-Japan trade deal. Because in the US-Japan trade deal, there has been a rumor, and this has been floating around in the market for quite a while, is that exchange rates will become part of the trade deal. And people are waiting to see whether or not financial variables, particularly the exchange rate, becomes part of the trade discussions. I don't think that that is going to be critical in the US-India deal. I think that is what really what the market is looking for, because if that becomes part of a country's trade deal, then all the rumors that you've heard over the last 1 week, what happened to the Taiwan dollar and what's happening to dollar CNY, etc., people will get much more faith that all of this is happening because there is some sort of a discussion about, some form of Mar-a-Lago deal that's in the offing. That's not a base case, but all that I'm saying is that the eyes will be on the US-Japan deal to see whether or not exchange rate and exchange rate management is part of a trade deal.
All right. Hi, Jahangir. Good to see you in as always. Jahangir, what do you make of what the Fed chair Powell had to say overnight? Some read it as a little bit more hawkish than what they expected, but he said risks are on the table post these tariffs and the markets are still to digest that. What was your reading?
So I think, broadly, everybody expected the rates to be unchanged, right? So that wasn't a surprise. I think people were also expecting a change in the language on uncertainty. So in the last two FOMC meetings, statements, they simply said that the outlook was uncertain. And I think there was a assumption going into the FOMC meeting that they would change the language on uncertainty and add words like increased uncertainty. And that's essentially what we got. And I think that is probably the most important shift in the language that we got from the Fed, is that they now see uncertainty to be increased, both in the inflation front as well as in the unemployment front. And I think that essentially means that given, so far, there hasn't been any real evidence of that, apart from the very high import numbers, that the tariff policies having an effect on U.S. growth or U.S. employment. That remains very, very solid, or on retail sales. But if you take that, the backward-looking data is still very solid. The fact that the Fed is saying that both on the employment front as well as on the inflation front, they see increased uncertainty, it just suggests that the Fed is, in a wait-and-see mode for a protracted period. And I think that's the inference that we are drawing from today's statement and from the press conference, that the Fed is here for the long haul.
So, Jahangir, exactly on that point, let's ask you what you're expecting at this point. So we've got 20 days of May left, then you have June left to get these deals done. Do you think that'll happen, first of all? And secondly, I'm sure it's hard to guess, but what is the blended average that the US might be at as these deals get negotiated? And then therefore, what's the impact on the economy you're penciling in?
Look, you're asking me things that I have no idea whether or not these things will be done, right?
Yeah.
Look, what we can make out is that these deals with these 14 or 18 countries is going to be done in 3 different phases, right? In the first phase, you have India, you have Japan, and you have Korea. We haven't seen any deal being announced. So maybe the India deal gets announced sooner rather than later, especially given the fact that India's already announced a deal with the UK this week. But as I said, critical is what is it that they announced with Japan? And once those deals get done, then you go to the second set of countries, which presumably we don't know whether or not that's, whether exactly what the sequence will be. Presumably is going to be UK, is going to be Euro area, etc. And then we go to the rest of the, countries in particularly in Asia, who are the manufacturing exporters. the point I think one needs to realize is that these deals are not going to be detailed announcements of exactly what is going to be done. As
Yeah.
Secretary Bessent has already said, these are
Yeah.
most likely going to look like sort of, letters of intention, right? This
MOUs,
is the
Jahangir. MOUs.
MOUs. Yeah, that's right, right. Then we have to wait for what the actual details are, right?
But Jahangir, trade and investment needs more than just letters of intent or MOUs, right? So my simple point is, U.S. economy by the December quarter, last quarter of the year, what is the sort of deceleration you're penciling in?
So we do have a second quarter growth rate actually turning positive, simply because you are not going to see a 51% increase in imports being repeated. You're going to see a negative number of imports. That itself should be able to give you a reasonably positive number over there. But we have as a baseline a recession in the second half of the year, with both the two quarters, Q3 and Q4, turning negative. And then the recovery starts in 26, with the Fed reacting to it in September by the first rate cut.
Got it. All right. Jahangir, we'll leave it there. Thank you very much. Good speaking with you. Thank you for coming on. And till next time, goodbye. Appreciate it. We'll tell you quickly what's lined up here on the show. So we have exclusive interaction coming up with the management of PB Fintech and General Catalyst. There's a big deal announcement there. 9 o'clock, you'll have the management of Niva Bupa. So some more insurance stock. Of course, Niva on numbers. Samir Arora will join us at 9:20 as a market march of the day. Hoodco at 9:30 with their fourth quarter numbers. Ashok Chandra of PNB will be speaking with us at 9:40 on their numbers. KPID Tech, there's an acquisition, small one, 950. You'll hear from the management there. And 10 o'clock, Venugopal Gare on India's strategy with respect to India-Pakistan and the tensions here. And as the economy, Lata in conversation with Sonal Verma and DBS banker Ashish Vaidya on the impact of war and trade war on Indian economy and the rupee.
Time to slip in a short break. You got a lot of stock-specific action to track for you. For the time being, I'll give you a sneak peek. We're looking at Coal India, United Breweries, Tata Motors, Lupin, Niva Bupa Health. All of them will be reacting to positive news flow, while we have on the flip side Dabur, Voltas, Blue Star, KFintech and UPL that will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. All right, so cues across Asia are all right. There's a mild gain coming through, so we're standing by for, there we go, Hong Kong markets looking better. Implied open will come up on your screen, and there are, of course, lots of earnings to go through as well. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Nigel, let's start with the Coal India first.
Well, Coal India's numbers actually look good. There was a beat if you look at the revenue, the EBITDA, as well as the profit number. The reason that the revenue beat estimates is because the blended realizations actually were better. The e-auction contribution as well was better, and that obviously helps the profitability. And the other point was that the reason that there was a beat on the operational front was because the employee costs came down by close to around 10% on a high base. So that's what helped them in terms of the margin performance. The PAT, you'll say, how come there's such a big beat out there? Well, the reason was there was higher other income. It came in much higher, jumped up by close to around 70%, a couple of one-offs in the PAT number, in the other income number, which explains why the PAT looks quite good. But we look at Coal India with the breakup, right? So the FSA numbers out there, what looked good there was the realizations. It perked up by close to 100% on a year-on-year basis. That was encouraging, a little bit better than what the street was working with. On the e-auction front, the volumes continue to remain more or less flattish to the mild negative bias. But what was good out there is the realizations did jump up by close to 2.2%, which was a pleasant surprise. Also, in terms of a contribution, in the last quarter, that's quarter 3, you had around 9.9% coming in from e-auction. This time around, it was 10.8%. Besides the good operational performance, they have given it a sweetener. They declared a dividend of around 5 rupees. That takes the total yearly dividend payout to around 26 rupees. And the receivables have come down, cash in the books as well, at around 16% of market cap, going with green on Coal India. But Mangalam's here to tell us about Dabur. Not too good, Mangalam?
Dabur, Nigel, it was a weak quarter that was expected. The company had given its fourth quarter update, and the weak quarter is what the company has reported as well, albeit a little weaker than what was reported earlier as well. Flat revenue growth, the EBITDA has actually declined a little more than anticipated. The net profit down by about 8.5% as well. So the street was working with a revenue of close to 2840 crores. The company's met that around 2830 crores, but the EBITDA expectations of 429 crores, they reported 427 crores, and a net profit expectation of 329 crores, they reported 313 crores. Domestic volumes have declined by 3%, and this against expectations of 4 to 5% decline itself. But more importantly, while the stock opens in the red, I'll watch out for whether it recovers or not, largely because of the new strategy that the company has announced of looking at double-digit compounding in revenue and profitability by investment in core brands, premiumization and contemporizing their portfolio, and bold bets across health and wellness spaces, which also include some of the M&A. So let's see how that pans out. The stock has been an underperformer. There has been derating. Can it turn around is something that the street will await.
All right, Mangalam, thank you very much for that. Let's talk about two other numbers, Voltas and Blue Star, which reported. Voltas, of course, came through with numbers yesterday. Upasana has got both. Upasana, morning.
Good morning. First up, let me start with Blue Star. Now, if I sum up the Q4 result, the revenue growth was in line, margin was below, but company's UCP segment, the growth moderated here, while EMP segment reported a strong performance. Now, coming to the numbers, revenue saw an uptick of 21%, which was largely in line, as mentioned earlier, and this growth was driven by company's 31% growth in its EMP segment and 15% growth in company's UCP segment. Now, UCP segment, the growth moderated at 15%, while the street was working with a growth of 21% on a YoY basis. EBITDA saw a downtick, was up 15%, stood at 279 crores, and EBITDA margin stood at 6.9%, which was down about 50 basis points, while we were working with a number of somewhere around 7.6, which was much below. Now, PAT stood in line largely at 194 crores, and overall, if we see, the company's order book stood at 6263 crore with an uptick of 9.9%. And coming to company's UCP segment, the UCP relatively lower, as company says that the April demand has been muted and it expects the demand to pick up in May and June 2025. Now, coming to Voltas, overall result was below expectations. Now, if we talk about the revenue was largely in line, up about 13%. EBITDA was up 74%, but below our poll estimates. EBITDA margin stood at 7%, while we were working with a poll of 7.5, so slightly lower. And PAT stood at 235 crore, while we were working with a poll of 247 crore, much lower. Now, company has lost its market share in Q4 and it stands at 19% as of March 2025 versus 20.5% in December, but company still retains its position in FY25 as #1 player in RAC. Now, Q4 UCP saw a strong performance of revenue 18% and margins was a surprise with an uptick of 90 basis points at 10%. And company's Q4 EMP segment remains a drag with a revenue up 4% on a YoY basis. So overall, I'm going with the red, but I won't be surprised if it recovers and stands in green, as the stock has recovered much in the last 1 month.
Okay. All right. Got that. Thanks very much, Upasana. Let's get back to Mangalam. United Breweries. At least here consumption is strong, Mangalam.
Cheers for beers. That's what we say. Why do I say that? Because, the revenues are a lot better than expected. We have the EBITDA and net profit even better than street expectations out here. And there wasn't much going on in this quarter apart from, the Telangana issue. So the street wasn't building in a lot of expectations. Revenues 2321 crores. The street was working with 2300 crores. EBITDA 186 crores. The street was working with a number of 173 crores. So on account of that, there is a 50 basis points beat on the margin as well. And the net profit at 97 crores, near 10% beat on street expectations of 90 crore as well. Domestic volumes, higher end of expected 4 to 5% range, and it has been led by premium beer. So 24% versus expected 24-25% growth in the premium beer range, and that's something that has been doing well for them. But if the fourth quarter was good, my sense is the first quarter will be even better. Why is that? Because of peak summer season. Telangana price hikes have been in the price, so obviously they will improve their operational performance there. There has been a reset in Maharashtra distribution that would help. The only offsetting factor would be the 10 rupees per bottle, increase in Karnataka excise duty. Let's see whether the company can weather that or not.
All right, thanks a lot for that, Mangalam. Well, let's go back to Sudarshan. He's here to tell us about Tata Motors. Well, sir, yesterday you told us a couple of reasons why Tata Motors is higher. Today you've got more reasons. Maybe Trump and the UK do a deal. Tell us more.
Today there is something new. It seems like that before Trump went to sleep, he decided to tease his upcoming press conference on Truth Social. He has posted that in the upcoming conference that he is going to have, in that one he is going to announce a big trade deal with a friendly nation. Now, after that, New York Times has come out with a report that that nation might be United Kingdom. And as per the report of New York Times, what does that report say? It says that deal, if it happens, it could be significant for both countries, but it's not clear what all details are likely to be in the agreement. Also, it's not clear if they will sign the agreement or they will they will mention the framework for the agreement. So we'll have to wait for those details to come out. It's likely India time around 8:30 p.m. and EST it's 10 a.m. Now coming to why it's positive for Tata Motors. If you remember JLR, which forms nearly 1/3 of its North America forms 1/3 of total sales of JLRs, and JLR does not have any manufacturing facilities in the US. That was the reason when US had announced tariffs, it was taken very negatively. Now JLR forms 30% of Tata Motors consolidated revenue, and because of tariff, stock of Tata Motors had seen a sharp fall. It did recover in the last few days, but if this news comes out, it would be positive. Also, it will help JLR maintain its targeted EBIT margin.
Okay.
Stock was the big gainer yesterday, 5% in trade, and so we'll see if there is more to go. I mean, the stock is kind of still beaten down quite a bit. So, by the way, interesting insight there. Before Trump went to sleep. We don't know if he went to sleep, right?
Does he sleep?
Never know. Never know with Trump.
He's on record saying he needs little sleep. He's built different.
Oh, God.
So, I mean,
at his age, my God.
Well, Lupin is the next one we're going to focus on. Ekta is here with the details. Ekta, over to you.
Thanks for that. Well, Lupin has launched Apitium generic in the US markets. It's basically a drug which is used for treatment of seizures. Why is it going to be in focus for Lupin? Because it's one of the first ANDA applicants for this particular drug and is eligible for 180 days shared exclusivity. I had a chat with a couple of analysts. They said that the opportunity is likely to be limited for Lupin. Around 4 to 6 FTF players for the drug already, which is first to file players, and hence Lupin could make around $10 to $15 million from the drug from this particular sale in the next couple of quarters after the launch.
Okay, all right. Thanks a lot for that, Ekta. Well, let's hop across to Vamakshi. She's tracking a couple of more counters. Vamakshi?
Well, good morning, Nigel. Let me first start off with KFIN. You know, sources are suggesting that the promoter group entity, General Atlantic PE, is likely to sell nearly 6% stake of in the company via block deals. Keep in mind that at the end of the March quarter, General Atlantic PE had a stake of somewhere around 32.9% in KFIN, and post this deal, the stake could fall down to as much as 27%. Keep in mind that sources also suggest that deal will be at a discount of almost 5 to 8% over yesterday's closing price. So therefore, going with a red for this counter. Apart from that, keep an eye out on Niva Bupa, going with the green for this one. Net earned premium saw an uptick of almost 25%. The underwriting profit was down nearly 12%. The combined ratio too increased by 338 basis points, but you know, it has come in much ahead of what Motilal Oswal was expecting. The operating profit is down 43%, but the net profit is up nearly 31%. We also have a note coming in from Motilal Oswal. They have a buy rating, target price of 100 rupees per share. They say that strong underwriting performance has boosted the company's PAT, and backed by a very strong performance in Q4, they've gone ahead and upgraded their gap estimates as well. So going with the green for Niva Bupa.
All right, thanks very much for that. UPL in focus with Ria. Ria Money.
Well, yes, good morning. UPL is expected to be in focus today since China has imposed levies on the imports of an insecticide called cypermethrin from India following a year-long investigation. These duties have been made effective starting yesterday, the 7th of May, and will be levied for a period of 5 years. These anti-dumping duty rates will range from 48.4% to up to 166.2%. Now, China's Ministry of Commerce has said that they have found that India was dumping this compound into the Chinese economy, and causing damage to Chinese companies, which is why this decision has been taken. Now, taking a look at the anti-dumping duty rates to be levied on each of these companies, for UPL, the rate will be 166.2%. We also have some other names like Meghmani Organics, Bharat Rasayan and Haranba Industries that will be taxed at a rate of 62%. Some unlisted players are also a part of this list, and the order has also talked about some other unspecified Indian companies that will be taxed at a rate of 166.2%. But as of now, UPL is taking the biggest hit, and we're expecting the stock to open in the red today.
Okay, well, that's the list of stocks that we are focused on. Well, there's a big deal which is coming in with respect to PB Fintech, and let's talk about that. Now, PB Health, which is the ambitious healthcare venture incubated by PB Fintech, Policy Bazaar's parent, and PB Health aims to create a streamlined insurance-linked healthcare network. Seamless, easy for the insured, has got some big funding, $218 million in total in this seed round. Silicon Valley's General Catalyst, which is a venture capital and investment giant with assets under management of over $30 billion, is coming into PB Health. PB Fintech is also putting in money along with other investors. Let's talk about this and get more details. Yashish Dahya is with us, Chairman and Group CEO of PB Fintech. We also have Neeraj Arora, Managing Director at General Catalyst. Gentlemen, great to have both of you here. Thanks very much for joining us. And I should say congratulations, Yashish and Neeraj, Prashant, this side. Yashish, and that graphic will come up on your screen. So you are, PB Fintech is putting in about $62 million. Neeraj is putting in, General Catalyst is putting in about $50 million. And the rest is coming in from institutional investors. Is that the broad structure for our viewers?
Yeah, not 106 million. About 90 something million is coming from institutional investors. About 10 to 15 million, between 12 to 15 million is coming from individuals who got the permission to co-invest in this round, and that would include me, it would include Alok, it would include a few others. Okay,
got it. Now, so $218 million in, right?
Yes.
Neeraj, good morning. On a lighter note, on a light, not a light, it's a serious question actually. Last time Yashish was on, and he wants to create something very different, right? And that's the mission. He's said it on the record. He said it to me many times that this is not about making money. This is actually trying to change how healthcare is delivered. And if he's successful, it'll be fantastic. But as an investor, Neeraj, and I asked Yashish this, how are investors going to come in? He said, well, they must be seeing something here. So I want to ask you, what are you seeing here? So go on, Neeraj.
Thanks for having me on the show, Prashant. First of all, obviously, we are really excited to partner with Ashish here. One of the biggest reasons for us to invest here is obviously Ashish and his team, right? What they have done with Policy Bazaar in the last 15 or so years, this is incredible, right? And they've created a lot of shareholder value for everybody who is invested in Policy Bazaar, right? He's a fantastic entrepreneur. I think he has a big vision with PB Health, and we couldn't be more excited to partner with him on this mission.
Yashish, just to get the shareholding now out of the way, right? With this investment, how is PB Health going to be held?
See, what you've seen is $218 million is the money coming in. And there is another $25 million of ESOP pool that we are creating. The ESOP pool is not being allocated on day one. It would be allocated over time to future management. But yeah, some part of it, about a third of that ESOP pool would get allocated on day one to existing management, which are the people who are running PB Health. And so that gives you a eventual valuation of $243 million. Now, if PB Fintech is investing 62, that gets PB Fintech something about $26 million. And of course, General Catalyst is a little over $20 million, 20%.
Yeah.
So about 26% is PB Fintech, about 20% plus is General Catalyst, and a few other investors are coming in who will have various shareholdings. And yeah, that's the way it would be structured. And that is after the dilution of the entire ESOP pool.
Oh, okay. Yashish, hi, morning, and Neeraj, morning to you as well. So Yashish, just to understand, I recall our last conversation where you had mentioned that eventually you saw PB Fintech, the listed entities stake coming down to about 25-26%. So with this round, this deal happening, I guess it's come to that level as you're explaining.
Yes.
Here onwards, will you bring down PB Fintech stake even more as more investors come on board? What's the roadmap from here onwards, say for the next 1 to 2 years? What are you thinking?
Nobody knows the roadmap. It will evolve.
Sure, but you're thinking. Yeah, you're thinking at this point. Yeah.
Personal view, and I must explain my personal view. My personal view was that PB Fintech, and that's the proposal I went to the board with, that PB Fintech should have taken about 11, 12%, 15% stake. That was the proposal I went to the board with. But the board decided that they wanted to maintain a minimum 26% stake, right? So eventually it's a board decision. I am the chairman of the board, but I don't decide just by myself. Right? So the board said, no, we want minimum 26%. Now, and that's why. So my thinking is, PB Fintech is not, there will be enough value in this venture that it will be a privilege to invest. However, PB Fintech, and that's what we had in this round, right? We eventually had to request most investors to invest less than they were willing to invest, primarily because there was a bit of an oversupply.
Yeah, there was the book was oversubscribed.
And so what happens in this situation is PB Fintech may have the same situation again. But then again, the board might come back. So PB Fintech has a right to retain 26%.
And you
Yashish, so that's a really important point, and thank you very much for making this so clear for us and for your shareholders as well. So PB Fintech's board has taken a decision that it has a right to retain up to 26% in PB Healthcare. In future, if you have more investors coming in and there are more rounds happening, then PB Fintech perhaps would have to put in more money to retain stake at 26%? Would PB Fintech
26%, of course.
Yeah.
There is no obligation. At the same time, there is no obligation for PB Fintech to invest in the next one. So PB Fintech can clearly say, I don't want to invest any further.
Okay, let me just, I think last time you were on, Yashish, you clearly said that there's no plans as of now to invest more beyond this round. Of course, we can never say no. That's the right way to put it?
Absolutely. See, it's not eventually my decision. Even for this decision, I went to the board with a proposal. The board came back with a proposal. Then that goes to the shareholders. Okay. And the shareholders, I actually wasn't expecting such a strong support. I think more than 80% of the shareholders said we want to make the investment. So eventually, it's a public company which is governed by a board and of course takes shareholder approvals before doing these things.
Yeah.
So I can have my views. But those are not the only views, right?
No, absolutely. Neeraj, I mean, what have you seen? I mean, have you seen this model globally? I mean, you're an investor around the world. Okay, what can you share with our viewers here? What could this scale up to, in your opinion, Neeraj?
So I think we've seen this model start to evolve in different parts of the world. I think here in the US, where we've been investing in healthcare for a very long time, I think a lot of healthcare delivery is moving to this model, actually. So if you are aware of this company called Kaiser Permanente, it's a very large healthcare system which has the whole integrated insurance and healthcare delivery all built into one, right? So I think as healthcare evolves in different parts of the world, I think one thing is very clear. You have to make sure the thesis of health insurance plays out. What that means is you make healthcare more affordable, accessible, and proactive, right? Traditionally, healthcare has always been more reactive, and that has been the case in India as well. But I think with the goal with PV Health and partnering with Ashish is to make sure that we can actually provide insurance and healthcare delivery to the middle class at a very affordable and in a proactive manner.
Yeah, Neeraj, this is a bet on Yashish, or this is a bet on the model, or it's a bit of both?
I think totally on both. Yashish is, obviously a legendary,
absolutely
operator and entrepreneur, and has created a lot of value for Policy Bazaar and PB Fintech. And when we came to us and he said, look, I want to build my next act in healthcare. we couldn't be more excited to work with him to take it to reality, actually.
Absolutely. Yashish, so the money's come in now. Tell us how this is going to be used. I believe you've already...
I want to actually focus more on what is it that we're trying to solve here, because that's the most important thing, right?
Yeah.
Of course, money has come in about 1,800 odd crores. We all know the mathematics. The mathematics is 1,800 crores broadly gets you about 1,000 beds. That's the maths, right? Everybody knows that maths. But that's not what we are doing. We're not setting up another hospital chain. We are not here because we believe we can run the best hospital in the country. Of course, we'll run a good hospital, just like anybody else. However, we are here for a very specific purpose. There is a conflict today. When a middle-class person turns up at a hospital, the hospital does not always we have the best healthcare in the world, by the way. It is just not affordable for the middle class. The middle class has to be very precisely defined, because a lot of us think we are middle class. We may have either moved out of it or we may not belong to it. The middle class is a person, as a family that is earning 50,000 rupees to 200,000 rupees in a month as a family. So if there are two people earning in the family, 1 lakh rupees each. That's what a middle class is, right? And we have 200, 300 million such people in our country. These people cannot afford to go to a hospital where the RPOP is the main target and the RPOP is 78,000 rupees or 75,000 rupees. Cannot afford it. And thinking that, insurance is somehow going to come as a magician and just pay is impossible. If the person can't afford it, then insurance also can't afford it. Today, I am speaking to every CEO in the insurance industry. You know what the reality is? The reality is after the third year, the claims ratios are upwards of 80%, 80% claims ratio. Right? Now, at that level, and it's only the beginning, by the way, the same were 75% 1 year ago. They're going up very rapidly. And this is going to blow up.
Yashish, and as you said, I mean, I think if you're able to solve this, we've had long conversations about this, and I think I completely agree. It's something which needs to be done, and only an entrepreneur can do it. I mean, you are, I think, by heart an entrepreneur, and all the best of luck to you. But we are, we can have a longer conversation. So let me just ask you, Yashish, to be specific, you've already bought the first hospital, right? The first sort of land and assets.
We have bought the first asset. That is true. We completed the acquisition of the first asset on 30th of April.
Okay. And you're saying, and that's about 200 beds. You spent about 200 crores.
That should get us 200 beds. That should get us 200 beds.
And you're in the market for another, what? I mean, three to four hospitals?
Look, let me try to be definitive, because I think people look for definitive answers.
Yeah.
I think by the time we are speaking this year, we will have 4 to 5 operating hospitals. And let's see, right? And I think mentally, we would have moved on from the setting up these 4 to 5, and we would mentally be thinking about where and how to set up the next 25 to 50.
So 4 to 5 hospitals by the end of this year, you're saying, Yashish?
No, I said by the same time this next year.
By the time, okay, in about a year's time, 4 to 5 hospitals.
Yeah, is the hope, right? That's what we are working towards. Operating hospitals.
Yeah.
And I'm thinking we would be planning about the next stage, which is going to be the next 25 to 50 hospitals. See, at the end of it, we will become a hospital chain like any other in the country, just like any other large corporate hospital chain. However, with a different ethos, with a very different ethos.
Absolutely.
Absolutely. No, let me explain. This is a very important part. Very, very important. We will make more money if consumers use us less. And I think that is the part, that is the penny that is not dropping on people.
Yeah.
That listen, if today 6.5% of customers go to a hospital, if that comes down to 4%, we will become more profitable, not less profitable.
Got it.
And I think that key thing
is the difference.
And that's the difference, right? For me, I will not be driven by RPOP. I am being driven by net present value of customer, my P&L starts with the insurance policy premium.
Got it. Yashish, 1,000 beds by the same time next year?
No, I did not say 1,000.
You said you started by 1,000. So 800 to how many beds then?
I did
by
not.
These 5 hospitals.
Prashant,
how many
you're
beds?
a very good person, but don't ever put words in my mouth.
You said
I'm very
1,000. You began by
specific.
around
When I
1,000
speak, I speak
beds. That's how it
very
came.
When I speak very specifically, and I don't mince words.
Okay. So how
I
many
said
beds?
4 to 5
Yashish?
hospitals next year.
Yeah.
By next year, it could be somewhere between 600 to 1,000 beds. You're absolutely right, but it is not 1,000. I did not say 1,000 beds will be set up by next year.
Okay. Fair enough. No, got that. So 600 to 800 beds, 2 crore a bed, and that basically consumes the capital that you've raised, approximately, right?
Yes, you are about right. Again, you are putting words in my mouth.
No, we're talking in the ballpark. We're talking in the ballpark, broadly.
In the ballpark, you're about right. Please do appreciate, today I have more tech resources and product resources than hospital resources.
Yeah.
So there are other things that are going on. We are working, we are coming at this from a tech-first perspective. Now, a standard hospital would say, why do you need so much technology? Consumers deal with this kind of technology.
Got it.
Well, let me explain, right? I want to give a single app experience to a family. This is a family app, not an individual app, wherein from the time when you buy insurance to the point when you get your claims, or there is nothing called a bill or a claim, everything is happening under one app, right? And it doesn't matter which insurance company you buy the plan from. It does not matter which of our hospitals you go to. So all of that experience is also very powerful. And all the data that you're capturing through that and helping, what is the objective of capturing this data? To identify problems early. To identify this customer could have a heart illness coming up 5 years later. Instead of making money from his surgery, I will make more money. And this is the important part. I will make more money by preventing that surgery. Why will I make more money? Because that customer is already paying the insurance premium.
Got it.
So me and insurance get joined at the hip.
Yeah.
That is the key here.
No, and we look forward to that success. We've all faced it, Yashish, as you said.
I think that's the key, right?
Yeah,
that's
absolutely.
the key.
Absolutely.
When I started Policy Bazaar, a lot of people asked a lot of questions. But when I asked people, okay, their experiences were they had been missold policies. They had not understood policies. So information gap was much bigger than the industry believed.
Yes.
I think our conflict of interest. See, today when I go to a doctor and he says, listen, for your son, you can have this kind of treatment equipment or this kind of equipment.
Yashish, allow me to come in. We're running into market open. We promise to get you back on, and we will discuss this in greater detail. And I think this story needs to be told properly. Thank you very much, though, on joining us on an important day. Thank you very much. Neeraj, thank you very much for joining us. It's good connecting with you as well. We take a quick commercial break here. Deepan Mehta joins us on the other side. Stay tuned.
Welcome back. Let's talk about a couple of other names then. Deepan Mehta, Director Elixir Equity, joins us on the show. Hi, Deepan. Good morning. Good to see you. Let's talk about a couple of earnings reactions. Coal India, they've got valuation comfort. The volumes are not coming about, but at least your receivables have come down and the operational performance look quite good. So any comment out there? Do you like the stock? And Dabur, well, the numbers were weak, but as Mangalam said, they were expected to be weak. Your take?
Najil, good morning and thank you for having me on your show. I think a decent set of numbers from Coal India. Last 3-4 years, the performance certainly has improved. Efficiencies have looked up. They've been able to curtail their labor costs as well. And they're getting higher yields also from the open market sales. But look, it's a mature business and volumes will always be growing at single digit thereabout. But if you want a steady, safe stock, then certainly Coal India, kind of fits that criteria. So I'd remain invested, but from a fresh investment perspective, maybe go for more exciting high growth stocks. Coming to Dabur India, I think all FMCG, traditional FMCG are all avoid at this point of time. And although they are, betting that a good monsoon and overall revival in consumer spending will improve their volumes. And if that does happen, it's a great opportunity to get out of all of these stocks. I think a lot of the categories have reached mature levels and the growth has been certainly the long-term secular growth of this sector now is in low single digits. So thereabout, in line with population growth and not in line with GDP growth anymore.
Okay, Deepan, stay on. We'll have some more questions for you. Quick break, come right back. We'll have, of course, some technical trading ideas as well, and also the pre-open rates will kick in. So back in a moment. Welcome back. Okay, just about a minute to go before the pre-open rates come in. Deepan Mehta is still with us. Deepan, we've had a bunch of the AC and cooler companies report numbers. Blue Star, Volta, Symphony's numbers look very, very good. Blue Star, at least for the AC business, the growth is a little lower than the street expectations. What do you think of all these three stocks? Do you like any?
Yeah, Surbhi, I think from a valuation perspective, again, disclosure we and our clients are invested. I think Symphony offers the best risk-return profile and very impressive numbers. I think even Voltas and Blue Star came with good set of numbers, but they are fairly valued. At least Symphony, there is scope for P's to move higher considering the kind of growth rates. And a lot of the problems are behind them in terms of receivables and the slow performance of their subsidiary companies. But look, there was a line of warning coming in from Symphony that this particular showers which are taking place, that certainly is going to impact the performance, at least in the short term. But these are great long-term secular growth stories. All of these cooling companies, air conditioning, air coolers are no longer kind of a luxury. They are a necessity. And I'm very convinced of the long-term prospects of the entire industry.
Okay, all right. Well, it's 9 o'clock. We'll start getting in the first rates any minute now. By the way, today is an important earnings day as well. Lots of companies like Asian Paints, many others reporting numbers. So it's a earnings heavy day. As the first rates come in, there's some weakness on TCS. There's a lever which is on the downside. We'll just see how this settles. The banks are doing better at opening glance right now. We have Mitesh and Sudarshan joining in as well. Gentlemen, good morning to both of you. Let's get some trading ideas in then. Mitesh, why don't you go first? What's the call on the indices?
Good morning, sir. So on the index, we maintained that we'll possibly be in that consolidation. I would look at closing about 24,520 for a breakout, and then the index moving up higher. Till then, it's 24,520 to about broadly 24,000 for me. On these stocks, I'm also trading with long bias, but I think I'll just cover them once you ask me to.
Yeah. Okay. Why don't you finish? Actually, give us the stocks as well, Mitesh.
So on the stock side, I have all buy calls today. APL Apollo is a stock which gave a good breakout after a few days of consolidation. So buy here with a stop at 1629 for targets of 1750. AB Capital is a buy with a stop at 195 for targets of 210. A buy on KPIT Technologies. Keep a stop below 1250. Look for targets of 1365. And Excite is a buy with a stop at 369 for targets of 390.
That's a strong opening for the rupee, by the way. 84.64 versus 84.83. So pretty solid. Those dollars from the FPIs, they've been coming in. That's the situation. Sudarshan, let's get to Sudarshan as well. Good morning, Sudarshan. What's your approach to trade today? Stocks and the index, of course.
Yeah, good morning. Well, yesterday I had said buy every dip, starting with the morning dip, and that view continues. I must quickly explain the difference between trend and volatility. The trend is up. The markets are slowly inching higher, consolidating, and I assume going higher. Volatility will continue. Volatility is that part of the market which goes up and down and eventually lands up, but then causes pain to everyone. That will not end. So today also, in next few days, I expect a lot of volatility. Every dip remains a buying opportunity because the trend is up. And should I talk about the stocks?
Yes, please go ahead. Stocks.
All right. Muthoot Finance is a buy with a stop under 22.58. APL Apollo, I also have that in my list. It's a buy with a stop under 16.21. Marico is a buying opportunity with a stop under 719. And I have only one intraday short, Gujarat Gas, which you can sell with a stop above 468.
All right. Good to get those trades from both of you, Sudarshan and Mitesh. Appreciate it. Deepan, I think, is still with us. Deepan, just a quick word on pharma as a pack, if you have any thoughts. because that that executive order, Ekta telling us that FD has now issued directions for more unannounced inspections, cost of inspections going up. I mean, sounded a little nasty. What's your sense, Deepan?
See, in Prashant and pharma, you have to try and go for the CDMO companies. And if you just see the result, I think OneSource, one of the new listings split from Strides, very impressive set of numbers came through over there. And that's true for Divi's Lab, also looking forward to great numbers from Suven in the longer term as well. So within the pharma space, that's where our focus on the CDMO companies. There's Blue Jet Health also. We discussed that company also in earlier shows. The general regular pharma company, the Dr. Reddy's, the Ciplas and Lupins, I think there's a cloud of uncertainty because of Trump tariffs as well. So I just like to be a little equal to underweight over there. And the opportunities are more in businesses which have a slightly differentiated business model.
Okay, slightly differentiated business model. I think the pre-open is settling down. And that what Surabhi mentioned, the move in the rupee is substantial.
Yes.
About a 20 paisa move. And there's no other reason except that there's no big move in the dollar, etc. It's essentially the lack of further escalation after the attacks yesterday, that the strikes that India carried out. And I mean, I think it's showing up in the rupee in a bigger way. Otherwise, I don't see anything else which is really happening in other currencies or Asian currencies or the dollar, or for that matter, anything else. Nigel.
Yep. Deepan, we spoke about Dawa. What about Daru? United Breweries, that's one of the top gainers in pre-open. The stock is up and about. It was getting very, very hot. Q1 could be better. Input costs as well have cooled off. Your take?
Yeah, I know, Nigel, but 125 times or thereabout trailing 12 months, how can you get great returns by buying at such expensive valuations? All I can say is that if you're invested in United Breweries, then remain invested. But from a fresh investment perspective, from these levels to expect a decent return, even outperforming the broad market indices, I'm not so sure.
Okay. All right. By the way, I was looking at the dollar index. Intraday yesterday, the dollar index had spiked quite a bit. Deepan, thank you very much for that. Really appreciate you being with us. Intraday, the DXY had spiked to 100. Then it cooled off intraday only. But from that high of almost 100, I mean, it's a little bit of a climb down on the dollar index. And if you see, that's a 0.23% decline on the DXY. And it's an equal gain for the rupee. Now let's pull up the dollar rupee. The rupee has risen by almost an equal measure. So it is a cool off in the dollar, as well as the fact that there's no escalation and the fact that flows are still coming in. Actually, speaking of that, let's straight away go across to our colleague Parikshit. Parikshit, morning. So, I mean, last evening you were telling us that shelling across the LOC was still pretty heavy. What's the latest, and what is the likely course ahead?
Well, tensions are simmering between India and Pakistan. The firing from the Pakistani side continues across the LOC and the international border. We are getting reports that overnight also there was firing in Akhnur, Baramulla, and other sectors of Jammu and Kashmir. There is a very high level of defensive alert. Why are we on defensive alert? Because we carried out a military operation, a kinetic strike on 9 terror camps across the border. But we cannot control the response of Pakistan. If now Pakistan acts in a disproportionate manner or ends up escalating things into a full-blown conflict, India has to be prepared. So currently our stance is a defensive one, and we're carrying out mock drills across the country. Yesterday, there was a blackout alert at Amritsar as well. We've been hearing drills and fighter planes from the Pakistani side. There are Air Force drills happening on the Indian side as well. So there is a lot of information out there, a lot of propaganda from the Pakistani media handles as well, and we have to be wary of that information. Having said that, what is confirmed as of now? Very heavy firing in Poonch area of Jammu and Kashmir. At least 15 civilians have been killed in villages across the LOC and the international border. 43 others injured. One soldier has lost his life in Jammu and Kashmir in Pakistani firing and ceasefire violations. We know that there is a very strong diplomatic outreach on the part of India. Donald Trump has said that what's happening is terrible, and he would like both sides to come to the negotiating table and stop things as soon as possible. So the Indian forces remain on alert. Shehbaz Sharif, the Pakistani Prime Minister, has said that India will have to pay, Pakistan will take revenge, and India now stands alert for any kind of response from Pakistan.
Okay, all right. That's on the latest in the border situation. Parikshit, quick update. The trade talks with the US. Anything moving there?
Well, we believe the things are moving well on the trade talks with the United States. India, according to our sources, has offered zero duty advantage for most of the product lines except for wheat, dairy, maize, and rice. Now, these were the red lines in negotiations as far as the Indian farmers and the community goes. Having said that, we believe that while the talks on reducing tariffs on goods have been progressing well, with the US, by the way, wanting to impose a 10% tariffs on Indian goods, there is still a lot of difference of opinion on how the non-tariff barriers should be treated. There are at least 67 trade barriers, non-tariff barriers, which have been put down on a list by the American side, shared with the Indian government, and they're asking the Indian side to reduce and remove and eliminate all those non-tariff barriers. This could be unequal treatment of American companies related to taxation. This could be regarding the antitrust law in India or the upcoming digital competition law of the Indian government. So these are some of the major concerns that the US had. But we believe that Commerce Minister Piyush Goyal is now traveling to the United States within the 2 weeks, and as early as the 19th of May, for talks with Howard Lutnick, the US Secretary of Commerce, and also probably Jamieson Greer, the USTR. Let's see if there's a breakthrough. But what India would like to achieve is that within this 90-day pause, currently there is a pause on the reciprocal tariffs for all nations. India would like to have a deal within this 90-day period and get a reprieve. So let's see what happens.
All right, now absolutely, Parikshit. Thanks very much. Very, very useful and important update there. 9:10 call. Sudarshan Mitesh are back with us. Sudarshan, what do you have?
APL Apollo, consider buying APL Apollo with a stop under 1621.
Mitesh, what about you?
I'll choose KPIT Technologies for targets of 1365.
Okay, KPIT is Mitesh's call. Gentlemen, thanks very much for that. I think the pre-open has ended. Tata Motors, let's just put the spotlight back on it, was a top nifty gainer. Sur is here with more. Sur.
The stock is higher 3% in pre-opening session, and it's on the back of international media reports after Donald Trump had put out on Truth Social about his upcoming press conference in which he said that he's going to announce a big trade deal with a friendly nation. And now, as per international media reports, it's likely to be the UK with which US is going to announce the trade deal. But New York Times report says that it's not yet clear about the details of the deal. We'll have to see if both the countries announce the deal or decide to detail out the framework for an agreement. But if it happens, why it would be positive for Tata Motors? Because North America forms nearly 1/3 of its total sales, and as far as Tata Motors consolidated revenue is concerned, from JLR, almost 70% it comes from JLR. JLR contributes 70% to Tata Motors consolidated revenue, and after the tariff, the stock of Tata Motors had seen a sharp fall after Trump had announced 25% tariff on all those. So we might see, but it has recovered in the last few days. We'll have to see how much gain is left more.
All right, thanks a lot for that, Sud. Well, let's hop across to Upasana. She's here to tell us about Voltas as well as Blue Star. Upasana?
First up, let me start with Blue Star. The company has reported a revenue growth of 21% on a YoY basis, which is largely in line with our estimates. And this growth was driven by 31%. That is a strong performance in the EMP segment, and the UCP segment, 15% growth, which nearly moderated. Now, UCP segment growth moderated at 15% on a YoY basis, while the street was working with a growth of around 21%. This growth has been moderated as company says that April has been muted and it expects demand to pick up in May and June 2025. Now coming to the margins of the company, the margins stood at 6.9% versus 7.3% with a downtick of 50 basis points, while we were working with an estimate of 7.6, much below our estimates. Now PAT stood largely in line at 194 crores. Now coming to Voltas, overall the result was below expectations. Revenue was in line while EBITDA, margin and PAT was lower due to EMP losses. Now EBITDA stood at 332 crore with an uptick of 74%, which was below our poll. EBITDA margin stood at 7%, which was slightly lower than our poll estimate of 7.5%, and PAT stood at 235 below our poll estimate. Now, company's market share stands at 19% as of March 25, which has declined sequentially from 20.5%, but company still retains its position as #1 player in the RAC segment. Now, Q4 saw a positive margin surprise in UCP segment at 10% with an uptick of 90 basis points, and company's EMP remains a drag with a revenue uptick of just about 4%, led by growth in domestic, and has reported a PBIT loss of 1.7 crores. So overall, weak results for Voltas.
All right. Okay, got it. Upasana, thank you very much for that. Results are weak, but the stock's actually not doing too bad in pre-open. Voltas is holding up with a gain of about 3.5%. So, I think positioning also kicks in. Blue Star, we don't have rates as of now, but Symphony is the one, cool as a cucumber, 10% up on Symphony because those numbers were very good. Mitesh, just very quickly, do you see any trades? Actually, it's 9:14. We'll maybe ask you later. But yeah, these are some of the key stocks to keep on the radar.
Let's just quickly take a look at what the other names are opening up like. And actually, we'll have to just countdown for the market open, and then we'll get down to some of these. So maybe just a quick look at, the Tata Motors stock and PB Fintech. We had the management with us earlier, amongst many others.
PB Fintech
as
flat,
part of the top 10.
Yeah.
Okay, all right. Well, let's just look at the indices at 17 points in the pre-open, at the end of the pre-open, and should start to come up. So 24,420 on the Nifty is what you have. The Nifty Bank is up about 1/3%, 54,799. You've got the mid-cap index up about 0.5%. The small-cap index, I think, is also starting in the green. So this is a decent start, all in the green, mostly in the green. And market breadth is 4:1 in favor of advances. The Nifty heat map will give you a quick sense of how we likely to starting at least on the Nifty, a quick snapshot view, and then we'll get down to individual names. And I think Tata Motors is still right on the top as far as the Nifty gainers are concerned. So
absolutely, it is 3%. I mean, any sign of a thaw, UK-US trade deal, all those drags that they're exporting to the US, I mean, that hope is that, that will really benefit the company as well. So that's the top gainer. Coal India is up about 2% after numbers. The banks are doing quite okay. Actually, the banks are leading from the front this morning once again. Axis Bank, Kotak Mahindra Bank, State Bank of India, banks and financials actually throw in something like a Bajaj Finance as well. So these are some of the stocks on the upside. The problem, however, is that beyond these financial names, nothing else in the market is really working. On the downside, you have Dr. Reddy's losing about 1%. There's ITC, Maruti, Eternal. So consumption plays, whether it's FMCG or discretionary. Lever is down about 0.5% as well. ONGC, Hindalco, TCS. There's no other leadership. So stocks are not falling too much, but then they're not rising also. There's hardly any leadership beyond some of the top banking names, which includes the likes of ICICI Bank as well. They're closer to the flat line, Jio Financial Services. Those are the kind of names. So Tata Motors and financials, that's pretty much it on the green side for now.
Well, that's right. Let's pull up a few stocks, though, from the frontline names. Voltas actually has opened up. The numbers looked a little bit soft, but I think the street liked the fact that the UCP saw strong performance, 18% growth, margins up close to around 90 basis points. So that explains why that name has opened gap up. The two big winners from the broader markets. We had pointed this out earlier that Symphony could be the stock to watch because those numbers were much better than what the street was working with. There was a 20% beat in comparison to what consensus was working with. The operating performance as well was good. And the stock from the peak actually is down more than 30%, even after this big bump up. So it'll give you incremental reason why, in fact, the stock could bounce back. Now, sustaining this start is going to be important. So Symphony is the stock we're talking about. Niva Bupa as well, they have been growing at a fairly decent rate. So I think the street likes that, and even the EOM has cooled off a little bit with the street likes. So that stock as well is up close to around 9%. Sonata Software, another one that's doing quite well. That stock, in fact, has opened up with good gains in today's trading session. Numbers fairly good out there. What's not doing well? CCL Products. After a big run that we've seen, it's cooling off a little bit. Remember, this week it's up close to 25%. It's down 3.5% or thereabouts. Dabur, the numbers are expected to be weak. They were weak. Hopefully things recover, but for the time being, the street is taking note of the past quarter's numbers. KFin, tech out there, we're expecting a large trade. I think that's taken place. So that's the reason why that stock, in fact, is more or less flattish. It started off actually with a cut of around 3% or thereabouts, but that one is bouncing back as we speak. Keep an eye out on the India VIX. In the last 7 trading sessions, the Nifty hasn't moved much, But the VIX on a low base actually has moved up by close to around 8 to around 9%. For the time being, it's cooling off. That's the fear index. You need to keep an eye out on that one as well. So a flat start. Broader markets, you have the breadth of the market still in favor of the number of stocks advancing. The Nifty Bank doing a relative outperformance today.
Absolutely. The Nifty, by the way, is down a little bit, 10 points lower. So neither here nor there, but 50 off the highs of the day, highs of the morning, highs of the last few minutes, actually. We've got, 3 stocks advancing to 1 stock, which is down. Samir Arora is now joining us, founder and fund manager at Helios Capital. Samir, good morning. Great to have you with us here. Thank you for your time. I just have to start with your kind of sort of reaction to what we've seen at the border. Very unfortunate with what's happening, but it is what it is, and you've got to sort of get through it. As a market person who's seen many of these play out earlier as well, what is your sense? How to navigate this?
So now actually that sense was before. Now anyway, part of it has played out. And it was natural to expect that there will be a response by India after Balakot and others, and it had to be a little higher level than that to teach a lesson. So the first part is over and it's confusing, but now I heard an interview in the morning the guy was from Dawn newspaper saying that Pakistan has already responded because the natural way this works is you escalate, that is saying India escalates. And in that, they sort of also say, this is it. We have not done civilian structure or military or economic. We have only done whatever terrorist. And then they also, naturally will give some response. And then they also have to de-escalate a little bit by saying, okay, this is it. So if that part is also already over and the Pakistani government thinks that they have already responded, then we are in the end game already. But otherwise, obviously, we are not expecting or anybody expecting that in response to the Pakistani response, there'll be another counter response because then these things can, move up the scale. But as of now, it would be that India has responded strongly and Pakistan may have already responded if they want to call it that, or they'll have to do something low impact to sort of then, because what also happens at this time is that by now US and others must be putting pressure on Pakistan saying don't do more than what you have done in response. And then we can say that a strong lesson has been given or a strong message, but obviously nobody is seeking, higher and higher levels of response and then counter response.
Yeah. Samir, hi, morning. So we can only hope and pray that Pakistan doesn't attempt any misadventures, as the army personnel were calling it. So let's park that aside for the time being, hoping that it stays as is. For the market as a whole, what next? I mean, we've had a great rebound in April, right? We got the benefit of being the least hit with all this trade talk. Now the index is about 7% away from the all-time highs. Now we come back to, I want to get your sense on the fourth quarter.
Very similar to you.
Earnings.
It is also now down 7% from its sort of high. So my thinking is that I am negative on US and very bullish on India, but the very bullish is contained in the sense that because the earnings are not coming.
Exactly.
So therefore, but still bullishness doesn't mean that it's going to make 25%, but bullish means you don't go back in the evening every day seeing a fall. And the reason for that is I think now, you always need one story in the backdrop and then rest you can choose stocks. And my story for that is that whether US does well or not, whether US has low tariffs, high tariffs, does deal with China or not, then the equity market investors worldwide will reduce their weightage in US. So it's not that if US has these deals, therefore people will put new money because they may realize it naturally. So first of all, there's a lot of inter-country or US tension with other countries because of the way this thing has been done and disrespect, and then saying I want to take over Canada or Greenland or Denmark, whatever, not take over Denmark, but all these things, or Mexico or whatever. So the point, and even otherwise people will realize that you cannot have so much of your exposure to US. And I was seeing actually on your channel only an interview with Jeffrey Gundlach, and he's saying, and actually I saw it somewhere else also, that about $15-20 trillion extra have been invested by foreign investors in US since the GFC.
Yeah, no, Samir, that point is very well taken.
That point is
yeah.
the point. That point is the point. Because if we broadly say that over the next 2-3 years, 1 year, that there'll be a little bit of reduction in the weight to US, we don't need to do anything else. We just have to be there.
Even with pedestrian earnings? I mean,
even with pedestrian earnings, because then you will go into things which don't have pedestrian earnings. So my thinking is that nobody will buy Indian IT, because why will somebody leave US IT, which is growing at much faster than Indian IT, and they are trying to distance from US and then buy something which has linkage to US. So in the end, I am very happy that the real sector will be financial sector, A, because the foreigners like it, B, because visually, on a top of the surface, it doesn't look as having done too well. And broadly, the companies are large and they have complete familiarity and comfort with it. And the valuations also look okay. And therefore, that is the number one spot. And then you buy here and there.
Samir, as you said, right, that the thesis that money maybe a little bit moves from, as they say, from west to the east and India here, right? I mean, it could be a big shift, huge numbers we're talking about. But is that, are we making, that thesis has become kind of mainstream now, but you think it'll play out?
Yes.
You just got,
that's what I'm saying.
Let me just complete. You just saw the earnings from Google and all the big tech companies, right? Actually, generally very good. So, it's to do with this exceptionalism, this extra 15, 18 billion.
Actually,
okay, they're not, very good. But they're not bad either, right? They are for that size, for that valuation, numbers are not bad. Let me put it that way.
That's what I'm saying. So there are, let's say, because we want 5 of these till Feb. Basically, if you see Apple was getting more than $25 billion from Google every year. And even if the attack from the Justice Department is on Google, and they say you can't pay, that is a direct loss also to Apple. Plus, Apple still has to deal with China in some way, because please imagine one more thing. We are saying that India is a big beneficiary of this shift, correct? Or, well, no, let's call it differently. India has a one chance or a good chance to be part of the new supply chain, whatever. This is a one shot for US to restructure global trade and all that. But it is also at the same time a one shot for China to not allow all these things to happen very easily. So China will not easily let everything happen that, okay, Apple says, I will move everything here, I will move everything to Vietnam and things like that. And China says, yeah, because Apple sells 10-15% of its sales in US. If you look at Amazon, also a little bit affected by the fact that God knows X% of their stuff comes from China. If you look at Meta and Google, some 10% of the ads come from these, Shine and that other company, Temu and all these guys who are selling these. So all of them are affected. It's just that we are looking at March results. But even forget about that. Even if their results are good, the point is that the world has realized that you cannot overdo any one thing. And also, if you see over the last 40, 50 years, for some 1 decade, US does well, then 1 decade, international does well, then commodities do well, then emerging markets do well. It's just that this time, the US outperformance lasted for like 2 decades instead of 1 decade. So it's a marginal thing. And we are, as I said in the beginning, doesn't mean we can be overly excited without earnings, without anything. Therefore, all I'm saying is, you can outperform and you can make a little bit more than others, and maybe in absolute make 8-10% before even our valuations will again look like going back to those very high December type numbers. But right now, that is the game. And then you choose some beneficiaries here, there of this FTA with, with US also one day, or whatever is the new deal, and also with UK and whatever else we do.
All right. Hi, Samir. Good to see you, Ben. You're sounding relatively optimistic, actually, on prospects of India, which is good. A couple of questions. Do you think that the low for the year has been done at around the 21,700, given the cues that we have as of now? And also, since you mentioned that financials is something that you like, stick to the big name, HDFC Bank?
All the big names, yeah. Because as I said, first of all, we already like them, so it's not that I am just finding a new reason for it. But I think this idea that... So previously, say about a month ago, I was saying that I am super negative on US, and on India cannot do much if US does very badly. So now the change is that US may not do that badly simply because, we in the end found that they are basically going back on many of the things which were going to create that negative scenario. But during that period and during this uncertainty, and because of just this realization by the world, because I am also a global investor in one fund, and so we ourselves are also going to buy more European things and European companies and Japanese companies, just because you don't want to be overexposed. Plus, whatever you may say, there is some questioning on the big 5, 6, 7 companies. Separately, Justice Department wants to break Google, things like that. These are all new things, and the idea was that this was being like Democrats would do it, but now even Trump is doing it. And so in general, that very easy trade that you buy these 4 companies and move on may still work, but the overall nervousness around US is there. By the way, you can see reports saying that hedge funds are at their lowest net exposure and whatever. So the point is that it's not that I am the first guy to think of it, but this change can stay.
Yeah, we had Nilesh of Kotak on the show yesterday. And Nilesh bhai, you know how he is, right? He said, "Subah ka bhula, jab sham ko ghar wapas aata hai, to bhula nahi kehte hai." He was talking about the FIIs, and that's what you're saying, right? They're coming back. So finally,
there's one more thing on this. That for 2 years, FII was selling and the domestics were buying.
Buying, yeah.
So this dream scenario that both want to buy, that dream is worth living for.
True. It's a good dream.
Only thing to remember, just to remind ourselves, is don't get carried away because earnings are not going up. But
exactly. Which is why I started with the earnings point. But we won't talk about that immediately. And we just hope these FIIs, they don't lose their way on Google Maps. They don't end up going to China because that trade deal will get signed. And then suddenly they realize, oh, China is, much cheaper than India.
By the way,
so there are always the ifs and buts, right?
We'll know tomorrow, but the underlying principle, according to me, is that 10% will stay for everybody. Now, the whole game is whether the sector tariffs remain or not.
Yeah.
And as of now, the impression for China would be not less than 40-50%. It can't be 10. If 10 happens, then India's story is gone. Of this part, that India is a beneficiary of this. No, that data will remain.
But they started with 145% tariff. They come down to 10.
They didn't start.
Exactly.
It was a counter.
Counter. So.
And in his campaigning, Trump had said 60.
Oh, okay. Yeah, I know. Yeah, exactly. So he said 60, went to 145. Now they'll talk.
50, something like that.
So as long as it's 40-50, we are good.
Meaningful. It's still meaningful for India to benefit.
Got it. So we'll watch out for this. Let's watch this space next couple of days. There's a meeting in Switzerland.
And tomorrow is also crucial with the UK. What if it is UK? Most probably it can't be India.
Yeah.
Because India is right now busy or distracted for some 2-3 days, 5 days, whatever.
Fair point, Samir. So we'll watch this space. We hope to get you back and have a deeper discussion about what more to do in our market here. But let's wait for some of these trade issues to settle. Looking forward to the next one. You have a great rest of the week.
Okay,
thank you for joining in. Thank you. All right, so that is Samir Arora saying the best thesis in town for the Indian market right now is the fact that FPIs need to diversify from the US and they will make India at least one of their homes. Let's get back to corporate commentary then and focus on some of the earnings. Hutco is the next company on our radar. For the fourth quarter, disbursals have been slightly weak, but the loan growth actually is still very strong. Asset quality is actually improved. So let's discuss the performance and the outlook with Mr. Kulshrestha, Chairman and Managing Director of Hutco. Good morning, sir. Great to have you on. Thanks so much for being here. We'll talk about the loan book and we'll talk about your diversification into much bigger infra assets in a bit. But I want to start with margins. Because you've managed to grow margins both year on year and quarter on quarter. Plus now I think you're eligible for this Section 54C, the bonds, the infra bonds as well, which help people save tax. So people love to invest in those bonds, right? To what extent will that bring down your cost of funds? And how do you see margins going ahead? Will this improving trajectory continue?
I think we are working on both the side, asset as well as the liability side. If you see towards our borrowings, we had cut down our cost of fund by using different methodologies and tapping different kind of resources, including the foreign currency resource. And we had been able to tap the Japanese market twice during last financial year, which has actually contributed towards our cutting down of cost of funds. And the company philosophy is to grow, but we also want that the projects that we are financing should be more competitive so that they will be more viable, more sustainable. And primarily, we are working towards the cut down of our cost of funds. So there are some internal measures that the company has taken. We had taken some external measures also, timing of the bonds, timing of ECBs. So all these things we are working, and now I'm very thankful for Government of India to pose the confidence in HUDCO, and they had given this window of 54 EC. And since HUDCO has started from the housing, so this will be our natural tap of 54 EC because these proceeds are coming from the 54 EC. So I'm sure by end of this financial year and looking at the horizon given by the RBI, I'm very sure that we will be cutting down our cost of fund from 6.75 to another 15 to 20 basis points. So,
which means NIMs, target NIMs for this year would be how much?
So NIMs we are continually improving, and now we are at 3.22. And as I had already stated, we generally works on the quality of the assets. So we will be able to maintain around 3.25 to 3.3% of the NIMs. But at the same time, we will not compromise on the asset quality. So you may have seen our presentation that we are cutting down our NPA levels, and now we are at 0.25%. Efforts are being made to resolve entire stress assets, and with another commitment that there will not be any new NPA in the company.
All right. Hi, sir. Good morning, and good to see you in. Give us a few details then. I think disbursals for the last year was at around 40,000 crores approximately. For this year, what are you aiming at in terms of disbursals? Where do you see your AUM headed from around the 1.2 lakh crore? And break it up for us between urban infra as well as affordable housing. What should the mix look like? Please go ahead.
I will start from the year, last financial year. I think there are a lot of things that the company had done, starting from the RBI has given the IFC status. Then we are in Navratna. Now Government of India has given Navratna status. Now 54 EC also had been given that window to HUDCO. And with all these, I'm sure in our last communication also, we had stated that we are poised to become 1.5 lakh crores company loan book by FY26. And now we are presently at around 1.25. So I am very sure that we will be achieving this 1.5 lakh crores. And regarding the second part of the question, so I think we are continually working on enhancing disbursement, and not only enhancing the disbursement, we are actually distributing our disbursement in Q1, Q2, Q3, and Q4, so that the income will improve the bottom line in that particular financial year only. So last year we had disbursed around 40,000 crores. So our internal target is between 50 to 55,000 crores, and our borrowings, we had taken approval of the board for up to 65,000 crores.
Okay, all right, got that. You want to give us how the mix as well will pan out? Urban infra and affordable housing, what should it look like? I think currently, if I looked at it, it's urban infra is approximately 61% or thereabouts, at least as of last year.
So as a part of the IFC, RBI has advised us to become 75% infrastructure. So we will be achieving 75% infrastructure by 2026. This is the advice of the RBI. So another 25% will keep on the housing side. So to be an IFC, it is mandatory requirement that we should have 75% assets under the infrastructure. But at the same time, I will also state that affordable housing under PMAY will remain our focus, and all efforts are being made. And affordable housing is also coming under the harmonized list of infrastructure. So 75% will take care of the affordable housing as well as in urban infra.
Got it. All right. You're also intending to resolve some stressed assets in the next 18 months.
Sure.
Give us the quantum, and if you could mention as well further details on this front.
Yeah. So presently we are at 2,000 crores of the NPA assets, and out of which 1,100 odd crores are in the, are under NCLT. And I'm very happy that around 800 crores out of this 1,100 crores is already got resolved, and they are in various phases of getting the money back. So NCLT has already ordered, be it liquidation or be it resolutions, and finally we will be getting this money back, and provisions will be get back during this financial year only. So the next phase is the another 400 crores we had identified, and They are also in the advanced phases, and I'm sure that out of 1,600 crores assets will be resolved in this financial year only. The matter of fact is that another 400 crores are in different levels of the DRT and DRAT. So we have a very focused approach towards the legal remedies, and we are also taken a route of revising our OTS policy, because we want that this capital should come back to the company and improve our bottom line. So that's why we had made a commitment that within 18 months of the time, we will become a zero NPA company.
All right, we'll leave it there, sir. Thank you very much for joining us.
Thank you so much
with that. Good luck. 20 points lower, by the way, on the Nifty, 24,390. We'll take a quick commercial break here. I think the PNB management should be with us on their fourth quarter numbers and outlook on the other side. Okay, 20 points lower, as I said. It's a bit of a turn, but not much. Broader market doing much, much better. Advanced decline is solid. PNB, as promised, is the next company we're speaking with. Our numbers were a bit subdued. Business momentum has slowed down. Margins are a bit under pressure. Net interest income has also seen some muted growth, which has come in the weakest in about 13 quarters or so. Ashok Chandra is Managing Director and CEO at Punjab National Bank. He's with us with what to make of these numbers. Mr. Chandra, good morning, sir. Thank you very much for your time. Prashant here.
Good morning. Good morning.
Good morning, sir. My question is exactly that. As I sort of preface my introduction, business momentum has slowed down. Could you tell us what is keeping loan growth tepid? What are you seeing in the marketplace?
Before I answer your question, just give me a few seconds. I express through the channel, I express my sincere gratitude to all my 1 lakh plus employees working from the the guard and the armed guard, the sub-staff, customer service associates, and all the officers in the bank, 18 crore plus customers, and all the investors who have reposed faith in our bank. Now, coming to the specific question, I think if you see our growth in the entire year, we have grown at the speed of around 14% plus now. Overall growth is 14.03%. And specific, if I talk about the global deposit, that has grown by 14.38%. And global advances, that has also grown by 13.56% YOY. So I think on all the business front, I think bank has done exceedingly well. Even the RAM sector also, if I can talk about.
Okay, yeah, so on that point, in terms of what you've guided for the next year, from about, for the full year, 14% credit growth, you now expect it to come down to about between 11 and 12%. Could you give us some context? Yeah.
Yeah. Guidance, in fact, last year also, we had given the guidance of 11 to 12%. And we have crossed that guidance and we have touched the growth of around 14%. This year also, our guidance is in the range of around 11 to 12%. And we are very hopeful that definitely we are going to cross this guidance. See, guidance always we give to see that we are going to meet those requirements. There are 14 parameters we have given the guidance. And I can give you the confidence that in all the parameters in 25-26, we are going to cross the guidance which we have given to the market.
All right.
And if I can give me time, I have a strong figure for those things. We have the backup for this guidance and the growth which we are projecting this year. If I can talk about the credit, we have around 85,000 crore of sanctions which we have done last year, for which the disbursements are pending and likely to happen in the Q1, Q2, Q3 onwards now. There are another 21,000 crore of the approval, which we call it as a NBG approval, which in this financial year we have given and for which the sanctions are awaited. There are around 28,000 crore of sanctions we have given in 25-26 in 1.5 months' time itself. So all put together, we have 1,35,000 crore of corporate book in our kitty for which the disbursements are going to happen in this financial year. So this is one strong book is there with us now.
Absolutely, sir. I mean, that's well explained, and we now understand where your confidence is coming from. even if that overall growth number is a little lower than FY25. But what about margins, sir? There's been some pressure, and going forward, it's going to be, all about how quickly you can reprice your deposits lower as the RBI cuts rates. There's been some pressure on margins in Q4. You are at the domestic NIMs I'm talking about, 2.96%. Will margins fall more in Q1, Q2?
I think margin which we have already bottomed out now, and this is the scenario is going to be in the Q1 and Q2 also. And the direction also which we have given to the market is in the NIM will be in the range of around 2.8 to 2.9% overall throughout the financial year. And especially for this Q1 and Q2, I think definitely there will be some pressure on the NIM, and we will be in the range of around 2.8 to 2.9%. See, whatever we have done in the last year on the deposit front and the deposit which we had mobilized, I think the cost of deposit has already bottomed out now. And I'm not expecting that any further growth and any further upside will be there in the cost of deposit now. Because there was one deposit scheme which a bank had launched for 400 days at 7.25%, which we have stopped in the month of April. And we have come out with a separate deposit scheme at 390 days at 7.10. And in the deposit other segment also, we have reduced the deposit rate by around 10 to 15 basis points. But impact of all those things will happen from Q3, Q4 onwards. So that is the reason I am telling that for Q1 and Q2, definitely there will be some strain on our NIM and NII. And the position which is there in the Q4, in the 24-25, I think that will be the position in the Q1 and Q2 will remain in the 25-26 also.
Got it. All right. Hi, Mr. Chandra. Good to hear your commentary, and good to hear that, in fact, you've given a cautious guidance, but you're sounding quite optimistic about outbeating that. That's the sum and substance, I think, of what you're saying. A couple of questions. Yes. Cost of deposits, you believe they've peaked out, but the guidance you've given on the deposit growth itself is very, very, subdued. You're only talking about 9-10% odd. That compares with around 14%. Why is that? Do you think on this front as well you'll be able to outbeat, the guidance you've given?
Definitely the guidance, so definitely we are going to outbeat. And the one reason, if you can see, the CD ratio of our bank is 71%. So there is enough room for us to grow in the credit portfolio with the existing deposit itself now. And that is the reason I think we have kept the deposit growth at the rate of 9 to 10%. Having enough liquidity in the market now and enough liquidity in our bank also, we have sufficient cushion to grow with this growth rate which we have forecasted.
All right. Besides the operational performance, your shareholders, your employees will be happy to hear, you're giving them a pat on the back and you're saying you're on a mission. So employees will be very happy. But shareholders will be wondering, do you all have a plan of unlocking some value? Maybe stakes you'll have in JVs and, other subsidiaries. Is there a possibility of some value unlocking that we should be looking at?
I think after assuming the charge, I have, in the very first opening remarks also, I have given the direction that we have 5 associates and 5 subsidiaries, and value maximization through the subsidiary and the associates will be one of the topmost priority for the bank. And I think all of you are aware that we have one stake in the Canara HSBC Life Insurance. There already the things are in the advanced stage. I think company is going for the listing. Maybe in the Q3, I think some value maximization will happen through that route. All other companies, we are not going to dilute our share in the market, but we are going to strengthen our position by improving their efficiency, by the resetting the skill set in that particular subsidiaries and associates. And through that route, we are going to generate a lot of values internally there.
So sorry, I missed that point. Which of the subsidiaries will list in third quarter this year?
Canara HSBC Life, already it is in advanced stage now, and it is in the public domain also. So that is one subsidiary we are going to get some value in the Q3.
Okay, and just very quickly, otherwise asset quality has been very steady. The only thing is slippages, have almost doubled. Was that one particular account? I don't know if it was MTNL or something, but just very quickly, 30 seconds on asset quality and what you expect.
Asset quality, if you see, we have done very well in the gross NPA front also, net NPA front also. Net NPA is 0.4%, and the gross NPA 3.95%. Yes, in the particular one quarter, Q4, there had been some slippages, and most of the slippages in the Q4 that has happened in the agriculture segment. That is 1,400 crore has slipped in that particular segment. And we are mindful of that. There were some restructured accounts were there, which was legacy accounts were there, and those accounts have slipped across the country. And already I can tell you that in that slippages itself, we have made a recovery of around 288 crore in this financial year itself in the month of April. So we are mindful of that, and I have already given the direction that our slippages ratio will be below 1% in 25-26, and we are going to restrict that. Even the MSME segment also behaving well now, and we are going to curtail the slippages further in the MSME and retail also.
All right, sir. Thanks a lot for joining in and filling us in with all those details. Wishing you, your employees, the entire team all the best, and we'll hold you to these numbers that you've given us for FY26. Well, let's focus from banking. Let's turn our attention to tech. KPIT Technologies, that's a stock on our radar. Remember, they have done an acquisition where they will be acquiring Caresoft's engineering solutions business for around $190 million. To talk about this development and the way ahead, we're joined by Mr. Patil, the co-founder and CEO and managing director of KPIT Technologies. Hi, Mr. Patil. Good morning, and good to see you in. Normally, from one quarter to the other, we have to wait for an entire quarter to pass. But this time around, you've done some inorganic growth. So we have the pleasure of having you on the channel again. Thanks a lot for joining in. Well, with regard to this acquired asset, I'm just looking at it. It does roughly around $51 million approximately. You've acquired it for around, the total acquisition cost is around $190 million. Tell us, what kind of revenue growth do you look at for this asset? And since you're saying that it will be EPS accretive, what kind of margins does the acquired unit command?
Yes, thank you. Thank you for the question. I'll just take 1 minute to tell you the logic, and then we'll come back there. See, the first thing is, as KPIT has established itself very strongly in terms of SDV and the software part, and largely the passenger car is our business, and there is a few important but few clients in terms of off-highway and commercial. We wanted to expand that segment. We wanted to bring an additional focus as an adjacency on that. And Caresoft really helps us to do that. I think that is one major part why we are doing that. The second part, which is very important, is beyond software now. If you look at what is on the mind of people, is the tariffs as well as the competition from China to handle that. They want to reduce the cost. And Caresoft has a very strong competence in that area, which can be leveraged by KPIT. So we are not buying that pure benchmarking business, but the data and that part, taking it to the solutioning is what KPIT can do. And the manufacturing efficiency is another part which clients are looking at, like more people setting up in US, and that's what we can help. I think this is the rationale for that, just to give you that idea. And for the 191 million, I think the key point, we believe it is EPS accretive, and is basically because we believe that there are a lot of synergies in terms of what we do, and we can, of course, as you know, the KPIT has been very strong in building the profitability over the period in spite of investing. So we believe that we should be in a position to. So the margins are pretty strong. It's absolutely more than 20% plus, more like 25%, and I think right now EBITDA for this entity, considering the fact that what we have the cost efficiencies together. So it is so that with that it is about 25%, and with that we should be in a position to really make it accretive from year one. That's what we are looking at, and we believe that maybe it takes some time, right, to actually go into the legal steps and get the approvals and integration. So if you leave the first year, which I'm sure we are going to grow and we are going to have quick win. That's what we always go for. We'll go very strongly on that. But over the period, we think we can bring a growth of between 20-25% a year on this in this business.
So from year two onwards, you believe that it could continuously grow from by 20-25%. Got it. If we look at the contribution, this will be roughly around 7.5% of KPIT's revenue. For this year, what kind of contribution you expect from inorganic segment to your total revenue pie?
It really depends upon the day. We are in a position to put it together as a fully integrated entity, but we believe it would be around 5% plus.
5%. Got it. All right. And, most of the cash that you have, or almost all the cash, will be going into this acquisition, right? I guess that's how the funding is done.
Yeah, but this year we'll generate more cash. This is over a period of 2 years, actually 2.5 years. The cash we have negotiated it in a very collaborative manner because, as I said, we are acquiring one part of the business and also partnering for the other part of the business strongly. So it's a more collaborative arrangement. So we have got a bit of a leeway in paying over 2.5 years. So we will be generating cash from our business. Next 2 years, we're generating cash from their business. So absolutely, I think that's our idea is to make it completely internal and probably have some room if we can borrow a little bit here and.
All right. So as of now, how much does China contribute as a percentage of your revenue? And with this acquisition, you will be able to further penetrate into China, right? So where do you see that contribution headed to? What kind of additional money will you have to invest, sir?
I must tell you that contribution to KPIT is minuscule at this point of time. Let me just come back and tell you what is our China strategy. There are 4 pillars of the China strategy. The first part of the China strategy is learn from China. China is very strong in innovation. And if many of our clients got unaware and they got caught unaware in looking at the speed of that innovation. And if we can bring that innovation to our client, that is great. So our first idea was to build a great presence in China, great relationships in China, and bring on board and build a technology presence in China, which we have done. And that's what first we are trying to do. The second thing is our clients, global clients who are in China, they are looking for a partner in China with the Chinese ecosystem, not an Indian ecosystem, not a European ecosystem. That is something which we can take back to them. And the third is, of course, there are these big Chinese OEMs which are successful, which want to go outside China, and how we can help them in China and outside China. And these are the 3 areas which we are building. So right now we are largely got a success on the first 2 parts, which is technology, understanding, and bringing it outside. The second is global OEMs going into China. And we have started some engagements with the Chinese OEM already. We have it's a very small, and we have started. But we believe we want to take a medium and long-term output because Chinese is going to remain the largest automotive market. And we want to build this and strengthen this presence. We know that it is not the easiest thing, but we know that is the most important thing.
All right. Mr. Patil, just before you go, besides talking about this acquisition, for the year, you've not given any concrete guidance. But just going by rough math, 5% this will contribute as a percentage of your revenues. You should end the year in the vicinity of around 950 to around $1 billion of revenues. Should that be, mathematically 5%, they're doing 50 million. So I'm just plugging in the numbers. Should it be closer to 950 to around $1 billion?
The first thing is that 50 million is for a year. And we don't know how many months we get here, right? We may get 8 months or 9 months, that's the same. And the rest of the business, I have mentioned very clearly that will take some time to come back. And, it's really, there are so many things happening. I know every day there is a new thing. Yesterday, I was at the airport or the flights got cancelled, right? And then I realized what happened. So things keep on changing in the dynamic world, but it will take me some time. I think we said that in the next by the end of the half year, hopefully we will be in a position to give a better view.
And we'll come back to you with that questions at that point in time. But thank you very much for joining us. I mean, China is a long game, as you told us last time you were on. And you're making your first steps in that sense. Not first maybe, but you're taking steps too as part of that longer-term strategy as far as China is concerned. That's Mr. Patil at KPIT Tech. Let's shift focus back to the market and get some global sort of perspective. A couple of quick things have happened last few days since the last time we spoke with Venugopal Garre, India head of research at Bernstein. So of course there is this escalation at the border. India has finally responded with those strikes yesterday. And we also have big news flow in terms of trade with the India-UK FTA, which has been signed. So a lot is going on. Venu, you've written on both these sort of developments in that sense. Just distill your thoughts as in terms of what this all means now for the market from here on. How are you looking at things?
Yeah, thanks, Prashant. I guess a lot of very interesting developments which have happened. And I think a lot of more developments are yet to happen. So if you were to just look at the global side of things, what from a conflict standpoint, what India did yesterday is perhaps just the starting point of what could be potentially a conflict that we need to see, whether it escalates further, whether there's a further reaction, and whether it becomes a full-blown war, right? So we don't know that yet, but of course I would have a view on it, but at this juncture, that's an unknown for the market. And the second point is a positive part that we seem to be moving and marching a bit more strongly on the geopolitical front, despite all the challenges that we've seen, especially in this area of trade. UK FTA signing might appear small in the scheme of things, given the small quantum of trade, which is goods plus services of about 60 odd billion, but yet it is just a starting point of the kind of trade treaties that we would be looking to do with other countries. And remember that India is behind on trade treaties per se from an FTA sense. So this is a good starting point. Now, both these events, in my view, are essentially positive markets and non-neutral markets. So that might appear strange, but that is the reality.
Sorry, you're saying they are neutral for market? They are neutral, you're saying?
No, actually positive for markets, both of them. And the first point might appear odd to you, that why would a conflict be positive for markets?
I see, I see.
Right?
So you want to explain? You want to explain that, the first point then?
Yeah, so I mean, look, we look at this history, and I'm pretty sure you would have seen a lot of literature and a lot of articles on this in the last couple of days. See, fundamentally, the point of view is this, that historically, whenever we have seen conflicts of this nature, even into 1999, when we had sort of a Kargil war, the market reaction has been pretty soft, in the sense that the declines have been pretty modest, usually in day one, day two, and thereafter the rebound has been fairly swift. And in 2 weeks or 3 weeks or a month, we've actually ended up being higher than where we were in the previous phase or before the conflict starts. So if you were to just think about it broadly, economic sense viewpoint, and the second thing is government finances. Now, economically, we are of the view that where we are fundamentally at this juncture in terms of a cycle, a conflict to the extent that we are seeing today is not going to be impacting the path from a point of view of where the economy is heading. So that is one very critical point of view. We are not at the peak of a cycle. We are somewhere in the mid of a cycle with a very supportive base. So that's one important part, which is very critical. And more importantly, I think geopolitically, since we are strengthening our relationships, with a lot of these direct engagements with larger countries like US and UK, this sort of also limits, in my view, the extent of which this conflict can escalate. Right. So these two things makes me believe that we are not going to see any major correction in the market. And if at all a correction happens, investors should be buying that.
Venu, but it is not positive then, right? I mean, you said that it's positive for market. That largely you're pointing to earlier conflicts and what markets have done. So in that sense, you're kind of sort of just pointing to price correlation, what prices have done post. But it's not fundamentally, it's not positive. Or are you saying that?
Oh, so this is more a reference point of view of market reaction to these events.
Correct. I thought so.
Yeah. So it's more a reference to market reaction, which tends to move up in a couple of weeks or 2 weeks post the event, right? So that's the history. Obviously, nobody wants a war or a conflict. So it's not positive from a point of view of the non-economic factors, right? That, of course, goes without saying.
Absolutely. So Venu, tell us a little bit about the earnings picture so far, fourth quarter. It's a pretty subdued picture. Expectations were subdued. Have you done any work so far? About 200, 250 companies have reported. Where are we at?
Yeah, so, if I were to just look at the earnings picture, I think we discussed this last time as well. There has been a pretty wide range in terms of performance within sectors, right? So even within financial sectors, you would have seen good numbers versus average numbers versus bad numbers. And I would probably say that, remember, this is fourth quarter, and to a large extent, what we're essentially seeing in Q4 is more, I would say, the impact of what we saw from a point of view of economic weakness that happened through the year. Now, if your first half itself had literally no growth in earnings, and earnings estimate cuts had just about started after Q3, you typically tend to see a lagged impact where whatever consensus is expecting is firstly not right to start with. The more important part is that is something which the market already realized, that there would be a difference between what consensus expects versus reality because of a forecasting error than anything else. So what I'm essentially trying to hint at is I would not read too much into the 1.5% of earnings cut that you've seen probably at a headline index level. It has nothing to do with how things would move forward in the next couple of quarters where things might start to look up. So that's the perspective I'm trying to bring in. So I wouldn't read too much into some cuts that we've seen in Q4.
Do you have you and your team, Venu, have a view on pharma as a space with regards to everything we've seen? That executive order onshoring, at least the attempt at it. There is communication from FDA as well.
Okay, look, we don't cover pharma bottom up, so I can't give perspective on that. At a top-down level, I'm in a very strange situation right now from an articulation of a view, because I started the year with downgrading healthcare or pharma to an underweight from being overweight last year. And after the sharp correction that you saw in the first 2.5, 3 months of the year for that sector, which was perhaps the worst performing amongst the worst performing ones, I neutralized the sector to an equal weightage sort of a stance. So equal weight doesn't really mean much. It essentially says that I'm not a big seller post this correction.
Okay, got it. Quick conversation today. Venu, thank you very much for joining us. Appreciate your time here on CNBC TV18. Well, I think markets are down about 24,395. We'll take a quick break here. Manisha Gupta will be with us and with commodities on the other side. Stay tuned. Welcome back. 15 points lower on the Nifty is what we have. Manisha is here with the top commodity, which is which we're going to focus on. Manisha, good morning.
Well, I'm looking at gold, Prashant, because we did see a bit of a profit taking from $3,500 to almost $3,200, but we are back above $3,400 at this point in time. So the corrections that you've seen in gold in the last 8 or 12 months have been very small and very few to begin with. If you look at the prices right now with the kind of gains that we are seeing, we're up by 30% in this year and up 45% exact in the last 12 months as well. Well, the support continues because of the uncertainty in the US and China trade talks. That has been one of the major factors that you've seen prices gain here. And then the US Fed also kept the rates unchanged for a third straight meeting in this month, while they, of course, did talk about concerns on unemployment and inflation as well, but not to a level where you have to start moving the interest rates. The markets also are looking at strong global investment when it comes to gold there. The ETF buying in most part of the world has been hitting near record highs or pre-COVID levels, and that has been supportive. It also has to do with the Shanghai volumes, which have hit a record highs into the market there. The street also is looking at very strong quota that has been assigned by China for its commercial banks to keep importing bullion. That clearly gives you a cue there. And we also have seen insurance firms in China continue to invest in case of gold. There also has been a Canadian Varta Capital that manages $2.8 billion, which says that they are betting on gold for lifting of returns for their investors. So this is a kind of statement that we see coming in from various mutual funds, and investors as well. I want to take you through on what the global central banks have been doing, and they have bought nearly 244 tons in the first quarter of 2025. Remember, global central banks have been buying more than 1,000 tons for the last 3 years every year, and the markets do anticipate that this year the number could be between 800 to 1,000 tons as well. So when you look at Chinese markets, they are holding 6.5% of the reserves in gold at a total of 2,292 tons there. When you look at the Indian markets as well, India has been constantly buying for many months, and while China has been expanding gold reserves for a 6th straight month in the month of April, if you look at the Indian markets, we hold 880 tons in cents of gold gold right now. This is on the end of first quarter, and the total holdings that we have in gold in our reserves stand at a tall 12%. If you look at last year, well, all of 12 months, 11 months RBI did buy gold, and this is what we've done in last few years. So last year was 72.6 tons of a buying, and we have been a constant buyer really. 2021 buying came in after 7 years of no gold buying by RBI, but as you can see, we have been consistent buyers, and in the first quarter of 2025 as well, India has bought nearly 3 tons of gold there. So finally, there are a couple of things to watch out for as we move ahead from here. One is going to be the US Treasury SEC sent to meet China top economic officials in Switzerland, and that this happens in the month of May. And then you also have the 4th round of nuclear talks between US and Iran. That's on 11th of May. So between 9th May to 11th May are going to be 2 very important dates, and gold will keep an eye on this.
Okay. All right, Manisha, got that. So gold continues to shine. Well, let's get back to equities and look at some buzzing stocks as well. Symphony, that's the cool cucumber, like we've been saying, on the back of very strong numbers. Upasana is here. Upasana, let's recap the Q4 performance.
Certainly. Good morning. Firstly, the company has reported strong set of numbers. The revenue stood at 488 crore with a growth of 47% on a year-on-year basis. This was mainly driven by India revenue, which saw growth uptick of 48%, and international was also up 44% on Y-on-Y basis. Now, EBITDA stood at 107 crore with an uptick of 88%, and margin saw an uptick of 480 basis points at 22%. Now, margin was aided by India business, which saw an uptick of 110 basis points, stood at 29.5%, and international business PBIT also turned positive this time around. Now, PAT stood at 79 crore with an uptick of 65% on a year-on-year basis. Now, company has shared its outlook. It says that the India summer began with a promising start, but momentum is mild due to erratic summer. The management also has taken a strategic move to exit from its 2 subsidiaries international, that is CT Australia and Empico Mexico, as these subsidiaries were undergoing major losses, and management was planning a strategic turnaround. But it has finally taken a decision to exit from these 2 markets, as company aims to concentrate on highly profitable products and markets is what they have indicated. So overall, strong set of numbers from Symphony.
All right, Upasana, thanks very much for that. We got the management coming up at 11 o'clock, and we'll ask them more. Stock's the big winner. Rupesh Shah is, of course, Symphony is going to be with us in about 30 minutes or so. We'll take a break. We're back. Lata, we're in... Okay, I think what we're going to do is talk about one more name before we...
Dabur. Manglam is here to talk about Dabur. It was always expected to be weak, right? With the Q4 update itself, Manglam, and well, they delivered on that.
They did, and it was slightly weaker than expectations, which is why the stock opened lower as well. Though from lows, it has recovered because the stock has been a rank underperformer in the FMCG space itself. So if you just look at the numbers, revenue, EBITDA, and net profit, all of them mildly below street expectations, which were anyway weak. We had domestic volumes which declined by 3% as well, versus the 4 to 6% decline expected. I'm looking at some of the brokerage notes that have come in. Morgan Stanley has maintained their underweight rating. They have a target of 396. They believe that there could be further earnings derating cycle that may come by for Dabur. ICICI Securities too has cut their estimates by 5 to 8%. They've revised their target price lower from 510 to 480 as well. And the most interesting point comes in from Jefferies, which says that in the past few years, the stock has derated from a peer multiple of 52 to 54x, which, Marico and Godrej Consumer would trade at, to about 41, 42x, which is a lot lower than its earlier peer set. For Dabur to actually not trade at valuations at which, say, Imami or Bajaj Consumer or the others trade, which is between 27 to 30 times, their reset, project research, the new strategy that the companies announced, must be successful. They too have lowered their target multiple on the stock to 45 times. Let's see where it goes from here.
Okay, all right. Manglam got it. Thank you very much for that. And with that, we have to take a very quick break, but we will come back on the other side. On our special segment, it's The Economy. Lata today speaks with Sonal Verma and DBS banker Ashish Vaidya on the impact of war and trade wars, of course, on the Indian economy and the rupee. Stay tuned.